we got another worse than expected inflation report in the form of the November PPI. Now, one of the reasons the report was worse than expected was that the markets were all trading higher right before the report was released. Now, Kevin O'Leary. And one of the things that's really bothering me about Mr. Wonderful is that he's acting as if he lost money on FTX because he lost $15 million. Well, what Kevin O'Leary doesn't like to acknowledge is the fact that the money he lost was the money he was paid by Sam Bankman-Fried to pump FTX. Yes, he took the money that he was paid and used it to buy FTX tokens and to invest in FTX, the company. But he wasn't investing his own money. He was gambling with the house's money. Or more correctly, he was gambling with the money that Sam Bankman-Fried stole from his customers and gave to Kevin O'Leary to promote FTX.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, and a prominent Bitcoin critic, warns all investors to be careful about Bitcoin. He believes that Bitcoin price will go down even lower. Peter gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar. Before listening to him, please ensure to smash the like button and subscribe to the channel.
If you look at the way the markets reacted to the hotter than expected inflation news, particularly in the precious metals markets, it indicates that investors are finally slowly waking up to the reality that when we get these bad inflation numbers, it's not a sign that the Fed is just going to have to fight harder to win its inflation war. It's a sign that the Fed is losing that war and that it's incapable of fighting hard enough to actually win. Ultimately, it's going to surrender. Inflation is going to win, and investors are slowly coming to terms with that reality, because when the number came out, gold did exactly what it's been doing. It sold off. All of its gains were erased. Gold was up better than $10, I think around $12, $13 before the number, and it went into negative territory, but just briefly, and it quickly recovered, and it closed up almost $8.50 on the day, just under $1,798 an ounce. Silver did even better. It closed up 41 cents at $23.46, so it ended up finishing the day with strong gains. Now, on previous hotter than expected inflation numbers, whether it was PPI or CPI, which we're going to get next week, gold and silver were getting crushed on the news that inflation was higher than estimates because of the fear of a more aggressive Fed fight. That would mean rates would be higher for longer, which would be a headwind for gold. Well, now the markets are shrugging that off. You still get the knee-jerk, reflexive kind of reaction as the algorithms immediately sell into that news, but cooler heads are prevailing, and people who are actually thinking are taking advantage of these computer sell programs to buy the dip in gold and silver because they understand that higher than expected inflation is not bad news for gold and silver. It is good news for gold and silver. It's bad news for the dollar, and the dollar did rally on the news. It was down before the news, and then it had a big spike, but it ended up surrendering most of its gains on the day. It still closed up, but just slightly. I think about 16 basis points. The entire gain on the week for the dollar index was just 0.4, and in fact, it closed below 105 for the second consecutive week. Gold only finished down the week about 0.1%. It ended last week just above 1,800. It finished this week just below, again around 1,798. But silver, not only did it have an up day of 1.6%, but it was up 1.3% on the week, closing at 23.46. Silver is now positive on the year by 0.2%, and it's 33% above its low from a couple of months ago. Silver is in a big bull market, and again, it's a stealth bull market. Nobody is talking about it, which is exactly what I want to hear: silence when it comes to this bull market, because the longer it's ignored, the more progress it's going to make. before it has an even meaningful correction. And that's not going to happen until a lot more people get off the sidelines and get into the market because they notice how much silver has already gone up. And my guess is that probably won't happen until the price of silver has doubled or more from its low. Taking a look at the reaction in the stock market to the worse than expected inflation news, the Dow closed pretty much near the lows of the day, down about 300 points. It closed the week with a 2.8% loss. S&P beaten up a little bit more on the day, down 0.7% and 3.4% on the week. The Nasdaq fared even worse than that. It was down 0.8% on Friday and down 3.8% for the week. But the big loser on the day and the week was the Russell 2000. That index finished down 1.2% on Friday, and it ended the week with a 5.1% loss. Of course, the bigger losers were in the more speculative type of stocks. Cathie Wood's ARK Innovation Fund down 1.4% on the day, but it finished the week down a whopping 9.2%. Now, one of the big losers on the week was Coinbase, and I want to talk about that stock in particular because it's now down better than 90% from the high that it made the day of its direct listing. Remember, it didn't do a traditional IPO, it just went for a direct listing. And the first price it traded at was $381. And on that very day, the price was bid up to $429.54. It's never been that high since. And I remember watching it tick up there. I was listening to the commentators on CNBC, and they were so excited about this move up in Coinbase. They thought it would keep on going. This was the best investment that anybody could imagine because it allowed for the most exposure to crypto and to the widespread adoption that everybody on CNBC was confident would follow. So this was the best way to play crypto. In fact, it was also the best way to play the NFT market because they eventually launched an NFT exchange. Well, the stock closed at a new low on Friday at $40.24. In fact, even on the year, it's down better than 80%. To me, this is a very ominous sign for Bitcoin. Yeah, it's still hanging out at the 17,000 level. As I'm recording this podcast on Saturday morning, it's just under 17,200. But again, as I said on my last podcast, we're creating a new ceiling, not a new floor. In fact, you would imagine that Coinbase would be gaining value because FTX, one of its biggest competitors, is no longer in business. Plus, one of the things that everybody is claiming is that we need regulation. Of course, we need it like a hole in the head, but everybody says we need to have more regulation in crypto, and Coinbase is regulated. Coinbase is a publicly traded company in the U.S., regulated by the SEC, so it should be the new favorite to win from the FTX demise because it has what everybody claims we want. It's regulated, so investors don't have to worry because you've got the government's good housekeeping seal of approval. But instead of benefiting from the collapse of a major competitor and the fact that it is regulated, it is suffering too. In fact, one of the people who is pounding the table the hardest for more regulation in crypto is Kevin O'Leary. And one of the things that's really bothering me about Mr. Wonderful is that he's acting as if he lost money on FTX because he lost $15 million. Well, what Kevin O'Leary doesn't like to acknowledge is the fact that the money he lost was the money he was paid by Sam Bankman-Fried to pump FTX. Yes, he took the money that he was paid and used it to buy FTX tokens and to invest in FTX, the company. But he wasn't investing his own money. He was gambling with the house's money. Or more correctly, he was gambling with the money that Sam Bankman-Fried stole from his customers and gave to Kevin O'Leary to promote FTX. Now, according to Kevin O'Leary, he didn't even invest the entire $15 million that he got from Sam Bankman-Fried. He only invested about $10 million. So he was able to keep $5 million, but he ended up having to pay that in commissions and taxes on the $15 million of income that he earned to be a promoter of FTX. But for him to be going out there now and pretending that he actually lost money, he lost nothing other than his reputation. But other people did lose real money. They weren't paid by Sam Bankman-Fried, and these people are a lot less wealthy than Kevin O'Leary. They took their hard-earned money and put it on the FTX platform, and they lost it, in part because of Kevin O'Leary. It's possible that some of the people who lost actual money in FTX, the reason they chose to open up an account at FTX and deposit their money or their crypto there was because of Kevin O'Leary's endorsement. So rather than pretending to be one of the victims of the scam, he should acknowledge his own culpability in helping to perpetuate the scam. Whether he knew it was a scam or not, he was paid to promote a scam, and that was probably one of the reasons he didn't do all the due diligence that he should have. And I think he should have been more forthright when he was publicly talking about how great Sam Bankman-Fried and FTX were. He should have disclosed that he was paid $15 million to express that opinion. Also, despite the collapse going on in crypto and Coinbase hitting a new record low, hardcore Bitcoin fanatics remain as enthusiastic as ever. I was listening to this interview with Max Keiser, who had predicted that Bitcoin would finish the year above 200,000, yet he has not tempered his enthusiasm one bit, nor acknowledged his mistake. Looking at Bitcoin in December, trading at around 17,000, no, as far as he's concerned, nothing bad has happened. Bitcoin is as strong as ever. In fact, he was scolding anybody who is complaining about their Bitcoin losses by saying they're just speculators, they're not investors. He said, if you don't have at least a 4-year time horizon, you have no business in Bitcoin. You should just take your money to a casino and gamble. Well, Max Keiser doesn't know the difference between investing and speculating because buying Bitcoin has never been an investment. It's always been a speculation. There is no return on Bitcoin. You are simply gambling on price appreciation. And now he claims that Bitcoin gamblers were in fact investors and they should just hold for the long term like Warren Buffett, whose time horizon is forever. The difference is Warren Buffett buys income-producing assets. He buys businesses that he thinks will survive forever, earn money forever, and pay dividends forever. Bitcoin doesn't earn anything and doesn't pay anything. It's not the type of asset that Warren Buffett would hold forever. In fact, Warren Buffett himself refers to Bitcoin as rat poison, so it makes no sense for Max Keiser to invoke the name of Warren Buffett as he is pumping Bitcoin. In fact, one of the other lies I heard Max Keiser tell about Bitcoin was the economic boom that is supposedly going on in El Salvador because they were smart enough to make Bitcoin legal tender. El Salvador is suffering dramatically. The losses are huge as a result of this blunder into Bitcoin. But not only is Max Keiser in denial of this reality, but in his mind, he has actually concocted an alternative reality in which El Salvador is thriving. We got another worse than expected inflation report in the form of the November PPI. Now, one of the reasons you know the report was worse than expected was that the markets were all trading higher right before the report was released. Dow futures were up almost 200 points, and gold was trading up over $10, back over $1,800 an ounce. The US dollar was lower because everybody expected the dollar to be weaker and gold and the markets to be stronger once they received the good news that inflation was coming down. But once again, investors were disappointed by a hotter than expected report on inflation. And again, it makes no sense to me that so many people expect inflation to be coming down when nothing the Federal Reserve has done thus far is equal to the task. In fact, it's not just that what the Fed has done is inadequate to reduce inflation, but the U.S. government itself has done nothing to reduce inflation. In fact, everything they've done is throw gasoline on the inflation fire because ever since inflation became an obvious problem that people were complaining about, the only response we've had from Washington is an increase in government spending, which just compounds the inflation problem. And as I've been discussing on this podcast, the Federal Reserve has been filling the pipeline with inflation for over 10 years. And it hasn't even turned off the spigot. All it's done is slow down the rate at which it pumps new inflation into that pipeline. In order to turn off the monetary spigots, the Federal Reserve has to move interest rates above the inflation rate. So long as the Federal Reserve artificially suppresses interest rates by holding them below the rate of inflation, something that would never happen in a free market, but as long as this is Fed policy, it is stoking inflation's fires, not putting out the inflation. And again, it's not going to make any headway unless it has cooperation from the government. You can't have fiscal stimulus and fight inflation. You need contractionary fiscal policy married with contractionary monetary policy to reverse this process. And of course, none of it can be accomplished not only without a severe recession, but without triggering a worse financial crisis than the one that was experienced in 2008, which is why the Fed is not actually fighting inflation. Of course, it can't admit that, so it has to pretend that it's fighting inflation while it secretly continues to create more. But turning to the PPI number itself, the expectation was for a 0.2% rise in November producer prices, and that would have matched the 0.2% from the prior month. Well, not only did the November number come out above estimates at 0.3, but then they went back and revised the October up 0.2 to up 0.3 as well. So in the way, the forecast was correct in that both November and October producer prices increased by the same amount, but it was wrong in that both months increased by 50% more than everybody expected. Now, the year-over-year number, which was expected to be 7.2 and a big drop from 8% from the prior year-over-year number, that did come down, but not as much as estimates. It came down to 7.4%, and that was actually above the consensus range, which went from 7.1 to 7.3. And if you take out food and energy, it was even a bigger miss. They were expecting an increase of 0.2. The real increase was 0.4, again, above the range of estimates, which went from 0.1 to 0.3. And adding insult to injury, they took the unchanged number that was reported in the previous month, and they revised that up to an increase of 0.1. Again, looking at the year-over-year core, taking out food and energy, the expectation was for an increase of 5.9. Instead, the increase was 6.2, once again above the consensus forecast range, which went from a low of 4.8 to a high of 6.1. Even if you take out food, energy, and trade services, it was another beat. Instead of rising 0.2, which would have matched the previous month, it increased by 0.3. And the year-over-year gain was 4.9. But the bottom line on this inflation report card is that even though it may not be an F, because it was a little bit lower than the prior month, it's still a D-, and that's not a passing grade. Even though it's still below the year-over-year numbers from the prior month, you're still looking at 7.4% year-over-year increase in producer prices. And even if you strip out food and energy, you're still looking at 6.2%. That's more than triple the 2% target. It doesn't matter that it's not 8%. It's nowhere near 2%. There is no real progress being made, and there's zero evidence that any of the so-called progress that has been made is permanent. There is no proof that this is anything other than a temporary decline in an ongoing upward trend, meaning that the high year-over-year rates of inflation that we put in may well be eclipsed in the next run-up. Everything ebbs and flows, and that's all that's happening with inflation.